Hey everyone, Longacres Finance here with the High Growth Dividend Stock Watchlist for June 2021. This is a monthly watchlist of the 30 best high growth dividend stocks on my stock screener. Each month I run my stock screener to search for quality high growth dividend stocks. Then I rank them using a scoring system and present the top 30 stocks on my watchlist. I also use this watchlist to make my personal investing decisions across my multiple portfolios. May was an interesting month as the market cooled off a bit. SPY, the S&P 500 ETF, was still up for the month by 0.66%. VIG, Vanguard's Dividend Appreciation ETF, was up 1.76%, and my monthly watchlist was up 1.51%. So while the watchlist for May beat the S&P, it underperformed VIG. But that's okay, I don't expect this watchlist to beat VIG or SPY every month. But I do expect that it will beat both over a long term, like the next 5 years or so. With the market being pretty hot last year and early this year, it is more difficult to identify fairly valued and undervalued stocks. The May watchlist only had 5 fairly valued stocks, which is the smallest number of fairly valued or undervalued stocks on the watchlist since I started tracking it back in September of 2020. With the number of fairly valued and undervalued stocks being so low, the risk that one or two of these stocks drifts the monthly return up or down increases greatly. And that is exactly what happened in May. The 5 fairly valued stocks had a negative return for the month, losing 0.20%. I'll talk more about individual performance later in the video. But since I practice a buy and hold investing approach, I don't overly concern myself with short-term paper losses. If I think a stock is a quality company to own, and I like them at a certain price, I should like the stock even more when the price drops. Therefore, I like to look at a declining price in a quality business as an opportunity to pick up more shares for a lower cost. If you're already a subscriber to the channel, welcome back. And if you're new here, consider subscribing for more weekly dividend videos and monthly watchlists. Alright, let's talk about the June 2021 high growth dividend stocks, and after I'll cover the historical performance. Here are all 30 stocks on this month's watchlist. There are 2 changes from the prior month. BlackRock and KLA Corporation have dropped off, and they are replaced by Monolithic Power and Morgan Stanley. Monolithic Power has appeared on the watchlist once in the past. It was on the March 2021 watchlist, and Morgan Stanley is making its first ever appearance. The average dividend yield of all 30 stocks is 0.92%, so not quite an attractive dividend yield. But dividend yield is not the primary objective of a high growth dividend strategy. What we are more interested in is high dividend growth and a high total return. The 5-year average dividend growth rate of all 30 stocks is a nice 19.7%, and the average payout ratio is 26.89%, leaving plenty of room for future dividend increases. 3 stocks on this month's watchlist appear to be fairly valued, and 3 more appear to be undervalued. That is 1 more stock than in the prior month, so still pretty slim pickings. And on average, the 30 stocks are about 21% overvalued. Let's take a closer look at each sector. The most popular sector, once again, is information technology, and we have a total of 9 stocks here. Texas Instruments still offers the best current dividend yield in the sector of 2.15%. All of the stocks appear to be overvalued, but CDW is still barely in that 5% fairly valued range. MasterCard, Texas Instruments, and Visa are all about 10% overvalued and look more attractive compared to Applied Materials, Intuit, Lam Research, and Microsoft. Monolithic Power, one of the new stocks this month, is about 12.5% overvalued right now. Technology stocks usually trade for high multiples, and therefore we may not see attractive valuation from this sector in the near future. The next most popular sector is financials, and we have a total of 8 stocks here. T. Rowe Price offers the most attractive current dividend yield right now of 2.26%. We do have one potentially undervalued stock here, and that is Intercontinental Exchange, that appears to be 1.74% undervalued. Charles Schwab and Market Access are a few percentage points outside the fairly valued threshold. Progressive looks to be grossly overvalued. However, we need to factor in that this stock pays a special annual dividend every January. The regular dividend is very insignificant compared to the special dividend, and therefore using dividend yield theory as a valuation metric for this stock is not a good idea. Morgan Stanley, the other new stock this month, offers the second best current dividend yield of all the financial stocks at 1.54%. It also appears to be about 28% overvalued, as historically the stock has offered a 2% plus dividend yield. Up next we have the consumer discretionary sector, with 4 stocks. Home Depot still offers the highest current dividend yield of the 4 discretionary stocks, with a 2.07% yield. Lowe's appears to be slightly undervalued right now, while Domino's Pizza and Home Depot appear to be fairly valued. Tractor Supply is about 13% overvalued based on dividend yield theory. As a sector, the consumer discretionary stocks appear to be the most reasonably valued right now. These stocks also offer some inflation protection, if any of you have concerns about rising inflation in the future. Consumer discretionary stocks have something called pricing power, where they can pass the cost of inflation onto consumers, which gives them more control over profits as opposed to some other sectors. Up next, we have the healthcare sector with 4 stocks. United Healthcare offers the best current dividend yield right now of 1.21%. United's dividend yield is actually larger than the other three stocks combined. I know some of these dividend yields are quite small, but many of these stocks have rewarded investors with strong capital appreciation in the past. Humana is the only healthcare stock that appears to be potentially undervalued right now. Up next, we have three industrial stocks. All three offer a sub 1% dividend yield right now, and all appear to be overvalued at the moment. We have one stock from the communication services sector, and that is Activision Blizzard, with about a 0.5% dividend yield. The stock appears to be about 20% overvalued right now. And finally, we have one stock from the materials sector, and that is Sherwin-Williams, with a dividend yield of 0.78%, and the stock appears to be about 12% overvalued right now. Valuation is more of an art than a science, and oftentimes stocks may appear to be overvalued for very long periods of time, especially if they experience periods of high growth. Dividend yield theory is just a quick valuation test and shouldn't be used as a sole determination to buy or sell a stock. You may have noticed that the stocks on my list are not in alphabetical order. The reason for that is because they are listed in order of their ranking. Cintas and Charles Schwab ranked the best using my scoring method. This is mainly why the stocks listed lower on my spreadsheet fall off and are replaced by new stocks. Alright, let's jump over and take a look at last month's performance and overall historical returns for the watchlist. The watchlist from May was up 1.51% last month, and the 5 fairly valued and undervalued stocks from May were down 0.2%. SPY finished in between the two with a return of 0.66%, and VIG had the best return of 1.76%. Even though the fairly valued and undervalued stocks from May had a negative return, they still have the best return since September of 2020 of 23.68%. VIG is still about 3% behind, with a total return of 20.76%. The entire watchlist falls slightly behind VIG with a total return of 20.7%. SPY remains ahead of VIG and the watchlist, but behind the fairly valued and undervalued stocks, with a total return of 21.66%. On a year-to-date basis, the fairly valued and undervalued stocks still have the highest return of 15.81%. The watchlist is in second place with a return of 13.57%, SPY is in third place with a return of 12.54%, and VIG is in fourth place with a return of 10.69%. Applying a buy and hold approach to the watchlist would have returned 1.37% in May. The same approach to only the fairly valued and undervalued stocks would have returned 1.25% for the month. The fairly valued and undervalued stocks have the best total return here as well, both on a year-to-date basis and since inception. The strategy is up 14.31% this year and 22.83% since September of 2020. The watchlist is in second place on a year-to-date basis with a return of 12.87%, but trails VIG since inception with a return of 19.85%. The 5 best returns in May came from Expeditors International of Washington, which was up 14.94%, BlackRock, which was up 7.05%, T. Rowe Price, which was up 6.78%, Activision Blizzard, which was up 6.65%, and Intuit, which was up 6.53%. The 5 poorest performing stocks were CDW, which was down 7.02%, MasterCard, which was down 5.62%, MarketAxess, which was down 4.35%, Intercontinental Exchange, which was down 4.1%, and MSCI, which was down 3.47%. Of the 5 fairly valued stocks for May, Charles Schwab had the best return of 5.17%. Domino's Pizza was also up 1.07%, and the remaining 3, Home Depot, Humana, and Intercontinental Exchange, all had negative returns. If the number of undervalued and fairly valued stocks remains small going forward, the volatility of their collective returns may be higher than normal. That's it, guys. If you have any questions or feedback, leave a comment below. Thank you for watching and see you next time.